Wealth follows patterns, not the ones they teach you in business school, not the ones your financial advisor mentions, but patterns that have quietly shaped fortunes for over 3 centuries. These patterns determine who climbs the ladder and who stays stuck on the bottom rung, and most Americans have never heard of them. Here's something to think about. Ever notice how every economic recovery seems to benefit the same people? The wealthy get wealthier, the middle class works harder but falls further behind. Working families struggle more each year. This isn't chance. This isn't corruption. This is mathematics, invisible economic laws that have operated since the early 1700s. Before we dive in, drop a comment telling me which state you're watching from. I want to see how far these money patterns have reached across America. Now let's talk about the first law. It's called Gresham's Law. In simple terms, bad money drives out good money. 400 years ago, when governments started mixing cheap metals into gold coins to stretch their gold supply, something interesting happened. People caught on fast. They hoarded the pure coins and spent only the debased ones. Over time, quality money vanished from circulation. Garbage money stayed in the system. That same principle operates today. Only now the metals are gone, replaced by credit, debt, and digital dollars. Think about it this way. When the Federal Reserve floods the economy with cheap money, when interest rates drop to near zero, when borrowing becomes essentially free, that bad money pushes out good money. Easy credit crowds out disciplined saving. Speculation replaces patience. Short-term gambling beats long-term planning. And who wins? Those closest to the money spigot. Major banks get access first. Wall Street firms, large corporations, private equity funds, they receive the first wave of newly created dollars. By the time that money reaches your paycheck through higher prices, increased rents, or delayed wage growth, its purchasing power has already eroded. Gresham's Law isn't ancient history. It's your grocery bill rising faster than your salary. It's your rent jumping 20% while your raise stays at 3. It's watching your savings account lose value to inflation while the S&P 500 hits record highs. The law predicted all of this 3 centuries ago. Now let's examine the second law. The second law comes from an Irish-French economist named Richard Cantillon. His insight was straightforward but devastating. Money is never neutral. When new money enters an economy, it doesn't lift all boats equally. It flows unevenly, enriching some while diluting others. Today we call this the Cantillon Effect. Picture a rainstorm hitting a valley. Areas closest to the storm clouds get soaked immediately. The far edges stay dry. In our modern economy, that storm cloud is the Federal Reserve and the banking system. When the Fed creates new money or Congress passes massive spending bills, the first recipients gain wealth rapidly. Asset prices surge, stock portfolios balloon, real estate values skyrocket. Executive compensation packages multiply, but for wage earners and retirees living on fixed incomes, consumer prices climb long before their paychecks catch up. You feel inflation's bite months before you see any benefit from economic stimulus. This isn't theory. This is documented reality. After the 2008 financial crisis, the Federal Reserve added over $3 trillion to its balance sheet. The stock market tripled. The net worth of America's wealthiest 1% soared. Meanwhile, median household income remained essentially flat for 7 years. Home ownership rates dropped to generational lows. That's the Cantillon Effect in real time. A law written in the 1730s, now running through every stimulus package, every bailout, every quantitative easing program. And here's where things get interesting. These ancient laws don't just explain the past. They predict the future. Every time policymakers try to fix the economy with cheap credit, they reinforce these patterns. Bad money crowds out good. Early receivers accumulate wealth. Late receivers pay the tab through inflation. You might think these laws are unfair. You'd be right. But they're not malicious. They're structural. The same way gravity pulls objects downward, money flows in predictable directions. Once you understand those flows, you stop fighting the current and start positioning yourself strategically. These laws exist. Whether you acknowledge them or not, you can ignore them and wonder why you're treading water. Or you can learn them and start swimming in the right direction. The choice has always been yours, but choosing requires knowledge, and knowledge changes everything about how you handle money. Let's pause for a moment. You've probably noticed a pattern. Every financial crisis seems to reward the same players. Every recovery pushes asset prices higher while wages stagnate. Every solution creates a bigger bubble down the road. That's not a system malfunction. That's how the system was designed centuries ago when early economists studied the first global markets. They realized money behaves like energy. It moves toward where it's treated best, accumulates where it finds the highest returns. It compounds in the hands of those who understand its nature. But there was another law, older than both Gresham's and Cantillon's observations, a law that locks inequality into place. It's called the Pareto Principle, often simplified as the 80-20 rule. In any system, 80% of outcomes flow from 20% of participants. Applied to wealth, 20% of people control 80% of resources, and when left unchecked, that imbalance compounds 10%, 5%, even 1%. You see this pattern everywhere. In 1896, Italian economist Vilfredo Pareto discovered that 80% of Italy's land belonged to 20% of its population. Today, that same mathematical relationship appears in global wealth distribution, corporate profit concentration, even social media follower counts. A small minority dominates most outcomes. The pattern has held for over a century because it's not about policy, it's about behavior and feedback loops. In financial markets, those who understand money multiply it. Those who don't lose it gradually through inflation, taxes, poor timing, and bad advice. The system doesn't reward hard work, it rewards understanding. Most Americans never study these rules. They don't read economic history. They don't analyze how money creation works. They don't understand the mechanics of asset appreciation versus wage growth. They just work and hope. But hope isn't a strategy when the game runs on mathematics. Let me be crystal clear about something. According to Federal Reserve data, the top 10% of American households now control 70% of all wealth in this country. The bottom 50% own just 2%. That gap has widened every single year since 1989. Every recession accelerates it. Every stimulus package reinforces it. This isn't a glitch. This is Pareto's law playing out in real time across the world's largest economy. Now let's connect these three laws and see what they reveal together. Let's connect the dots. Gresham's law explains why currency quality degrades over time. Cantillon's effect explains why new money favors those nearest the source. Pareto's principle explains why inequality expands rather than contracts. Together, they form the invisible architecture of modern finance. A structure so old and so effective that even wars, revolutions, and technological breakthroughs haven't changed its fundamental operation. And here's the paradox. The same laws that widen the wealth gap can also help you escape the bottom tier. Once you understand how they work, you can move differently. You can hold assets that resist devaluation. You can position yourself closer to the source of new money through investments, business ownership, or equity participation instead of remaining the last recipient in the queue. Before we explore how these 300-year-old principles evolved into modern policy, think about this. Every financial crisis you've witnessed in your lifetime. .com bubble. Housing crash. COVID pandemic. Each one played out according to these ancient laws. Money expanded. Quality declined. Early receivers profited. Late receivers absorbed losses. The ratios shifted, but the rhythm remained identical. In the next section, we'll trace how these laws shaped central banking, global finance, and the dollar's dominance. Because once you see how money laws become power laws, you'll never look at the economy the same way. By the 19th century, these money laws began shaping nations. Industrial revolutions, transcontinental railroads, colonial empires, all operated under the same quiet mathematics. Those who controlled money supply controlled outcomes. Those who received new money first built dynasties. Those who received it last funded everyone else's growth. Central banking turned these ancient observations into official policy. Britain led the way. The Bank of England, founded in 1694, started issuing paper notes backed by gold reserves. It lent to the crown, collected interest, and expanded money supply through commercial loans. Gresham's law activated immediately. Every time paper replaced metal, real value left the system. But the Crown and London financiers gained leverage. They could fund naval fleets and colonial expansion without waiting for tax collection. That model spread globally. France adopted it. Then the Netherlands. Then the young United States with Alexander Hamilton's controversial First Bank. By the 20th century, the Cantillon Effect wasn't a side effect. It was strategy. Central banks managed demand, stimulated economies, and financed governments through credit creation. Those closest to issuance grew larger and more powerful. Commercial banks, investment houses, government contractors. Ordinary wage earners absorbed the inflation that followed. This structure now defines the global financial system. Every bond auction, every corporate bailout, every round of quantitative easing follows the same script. First receivers thrive. Everyone else adjusts. Gresham's law operates when excess credit pushes out productive capital. Pareto's law ensures wealth concentration. You see it when asset bubbles form. When housing becomes unaffordable for young families. When student debt reaches crisis levels. When a medical emergency can bankrupt a household. These aren't isolated problems. They're predictable results of laws that never changed. To see how they work together, look at 1971. That year, President Nixon ended the dollar's convertibility to gold. Money became pure fiat currency. From that moment, debt and dollars merged into the same instrument. The supply of both expanded together, and constrained by physical commodities. Gresham's law predicted what came next. When quality money disappeared, the system filled with quantity. Inflation accelerated. Savings lost purchasing power. Investment turned speculative. The Cantillon Effect made the wealth gap visible. Those near the source multiplied wealth through leverage and asset appreciation. Working Americans watched prices climb faster than wages. Pareto's ratio hardened into concrete. The top gained share. The base lost ground. You live inside that structure right now. Every policy response since 1971 follows the identical pattern. In 2008, credit markets froze. The Federal Reserve printed trillions. Asset prices recovered within 18 months. Workers waited years for wage growth. Unemployment stayed elevated until 2015. In 2020, stimulus checks arrived after markets had already rebounded. By the time households spent that money, inflation had reduced its purchasing power by 20 to 30% depending on your spending category. Understanding these patterns isn't cynicism. It's clarity. When you see headlines about interest rate decisions, deficit spending, or quantitative easing, you're watching ancient laws in motion. The terminology changes. The mathematics doesn't. So how do you use this knowledge? You start thinking like the early receivers. Money is a current. It moves fastest near its source. You need assets that float in that current. Businesses that generate cash flow. Equities in productive companies. Real estate in growing markets. Intellectual property. Skills that command premium compensation. Wages alone fall behind because they adjust after prices rise. The system rewards ownership over labor. This explains why the wealth gap widens even during economic expansions. Each round of monetary expansion pushes more credit into financial assets. The owners of those assets benefit twice. First, through rising prices. Second, through access to cheap borrowing that they can deploy into more assets. Workers receive the spillover later as inflation and increased living costs. Let me give you a concrete example. Suppose the Federal Reserve cuts rates and launches asset purchases. Corporations borrow cheaply to buy back shares, boosting stock prices. Investors see portfolio gains. Executives collect bonuses tied to share performance. Now consider a typical household. Their savings earn minimal interest. Housing costs increase. To keep up, they take on debt. Student loans. Car loans. Credit cards. That's the Cantillon effect in action. You can track this effect through Federal Reserve data. Between 1989 and 2023, the top 1%'s share of U.S. wealth rose from 23% to over 32%. The bottom 50%'s share fell from 4% to 2%. Each recession accelerated the transfer. The laws held constant. Pareto's pattern shows up in markets too. A handful of companies drive most index returns. 7 tech giants account for most of the S&P 500's gains over the past decade. A few thousand hedge funds control trillions in assets. A small number of traders dominate daily volume. In every category, concentration increases because feedback loops favor scale. Once a group gains early access to capital, it reinforces itself through compounding returns and preferential treatment. These dynamics aren't limited to the United States. Look at Japan. Decades of zero interest rates and asset purchases enriched corporations and long-term equity holders while crushing savers. Look at Europe. Monetary union transferred wealth toward Germany and the Netherlands while periphery nations struggled with austerity. Look at emerging markets. Dollar strength pulls capital flows, often against local economic interests. The rules operate globally because they're mathematical, not political. Now consider what happens when trust declines. Gresham's law warns that when people suspect devaluation, they hoard quality. Today, quality means scarce assets, land in desirable locations, precious metals, productive equities. Sometimes Bitcoin and other digital stores of value. Every rush into alternatives represents the same behavior ancient merchants showed when coins were debased. They withdrew from bad money and held what couldn't be printed. For policymakers, this creates a trap. To support growth, they need expansion. But each expansion lowers quality, triggering flight to safety. To restore confidence, they must contract. But contraction slows growth and risks deflation. The cycle tightens until confidence becomes the only anchor holding everything together. That's where modern finance stands. Sustained by faith in laws written 3 centuries ago. Your response to these laws determines your outcome. If you rely solely on wages and cash savings, you're the last receiver. You feel inflation first and prosperity last. If you own productive assets, you're closer to the source. You capture the early flow. That difference compounds over decades. It defines economic mobility. It determines whether your children start ahead or behind. This knowledge also explains political polarization. When the majority senses that growth benefits others first, they resist the system. When trust erodes, populism rises on both left and right. When policies favor asset holders, debt expands to appease everyone else. Each response layers new credit over old, reinforcing the cycle. The outcome becomes predictable. Currency value erodes slowly. Debt ratios climb toward historical highs. Markets depend on continued stimulus. No one can afford to stop because stopping triggers collapse. Yet the structure endures because each actor behaves rationally within it. Congress spends because voters demand programs. The Fed prints because markets need liquidity. Banks lend because rates are low and regulations encourage it. Investors chase yield because cash loses value. Workers borrow to maintain living standards because wages lag. Everyone acts logically. The system still decays. You're not powerless inside it. But you must stop thinking linearly. These aren't random events. They're mathematical functions. Once you see them as laws, you can plan within their constraints. The final piece shows what comes next. How these same 300-year-old principles will shape central bank digital currencies, de-dollarization debates, and future wealth distribution. The world now runs on code instead of coins. But the same money laws determine outcomes. You can change the platform. You can't change the physics. Gresham's law, the Cantillon Effect, and Pareto's Principle still describe how value moves, who gains first, and how wealth concentrates over time. Start with digital money. Central banks worldwide are building CBDCs. They claim it's modernization. In practice, it extends control and surveillance. When money becomes programmable, issuance and access can be targeted precisely. Early receivers will still gain first exposure. In emergencies, stimulus can flow directly to individuals. But the logic doesn't change. Those closest to currency creation remain ahead. Those furthest adjust later. Private cryptocurrencies follow identical patterns. Each boom begins with early insiders holding large allocations. As adoption spreads, new entrants pay higher prices. When liquidity expands, value shifts upward to earlier holders. Gresham's law appears again. When poor projects flood the market, quality tokens disappear into cold storage. Garbage coins circulate. Quality exits circulation because trust breaks. De-dollarization debates show another law at work. Nations holding dollar reserves understand the pattern. The issuer benefits first. Every new dollar entering global trade strengthens America's access to goods and credit. Foreign holders get later claims. Over time, that imbalance drives diversification. They seek gold, commodities, yuan, euros. Anything that reduces dollar concentration. The law repeats. Bad money chases out good until credibility resets. Inflation is no longer a local issue. It's a global function of credit growth. From 2000 to 2024, total worldwide debt more than quadrupled from around $80 trillion to over $300 trillion. Every stimulus program, every deficit, every rescue operation added to the pile. Debt became the asset class. Without it, no market clears. Central banks now hold trillions in sovereign bonds. That makes them simultaneously buyer and regulator. They stabilize markets by owning them. This is the purest expression of the Cantillon Effect. The state issues debt. The central bank purchases it. Commercial banks use it as collateral. Asset prices rise. Wages trail behind. It looks modern. It's ancient. What happens next depends on how long confidence holds. The system cannot unwind debt without destroying collateral values. It cannot expand indefinitely without eroding purchasing power. The only remaining path is management. Extending maturity dates. Lowering real yields through inflation. Shifting perception through narrative control. When trust weakens, investors move to scarcity. Gold demand increases. Real estate in stable regions surges. Equities linked to tangible production outperform speculation. Digital assets with capped supply attract attention because they resist arbitrary expansion. Each movement is rational under Gresham's principle. People always trade away what loses value for what retains it. If you want to navigate the next cycle, study proximity. You cannot stop credit creation, but you can move closer to its source. Own assets that benefit from early liquidity. Avoid investments priced purely on hope and narrative. Diversify across forms of money and stores of value. Track policy shifts, not promises. History shows these transitions repeat with remarkable consistency. In the 17th century, debased silver wrecked Spain's empire despite its colonial gold. In the 18th, Britain's paper experiments funded naval supremacy. In the 20th, fiat currency financed wars and welfare states. In the 21st, digital credit finances everything simultaneously. The surface changes. The core mechanism endures. You live in a system where value is assigned through policy, not discovered through markets. When new money enters, it rewrites prices. It rewards debtors over savers, owners over wage earners. You cannot wish that away. You can only position yourself strategically within it. Look ahead 20 years. If inflation averages 3%, your cash savings lose half their purchasing power. If asset inflation outpaces wage growth, ownership gaps will double. Pareto's ratio will hold firm. A minority will control the vast majority. That's not conspiracy theory. That's compound math. Governments will respond with redistribution proposals. Wealth taxes. Digital tracking. Universal basic income. Each fix adds complexity and requires funding. More funding means more debt. The circle continues, but awareness matters enormously. When you understand the laws, you stop chasing noise. You see stimulus as timing, not salvation. You measure policy by flow, not stated intent. You build habits that align with structure rather than fighting against gravity. Invest early in your earning years. Hold scarce assets that appreciate faster than monetary expansion. Minimize liabilities that compound against you. This is the lesson buried in 3 centuries of financial history. Prosperity follows knowledge of cause and effect. Gresham warned about quality degradation. Cantillon mapped the sequence of money's impact. Pareto described concentration's mathematics. Together they explain why some people climb while others work just as hard but tread water. Money is information. Power comes from reading it accurately. Most Americans study careers, not systems. They trade time for currency without asking who issues it, when they issue it, and at what cost to purchasing power. Once you start asking those questions, patterns emerge clearly. You stop reacting emotionally to headlines. You start planning strategically around incentives. The world is entering another monetary experiment. Interest rates fluctuate. Debt grows past sustainable levels. Trust in institutions wavers. These same laws will decide outcomes again. Those who learn them early will adapt first and position correctly. Those who ignore them will notice the consequences too late. You're not excluded from this story. You're already in it. Every transaction, every loan, every investment feeds the mechanism. The only question is whether you understand your position within it. So, as you finish this video, think about proximity. Where do you stand in the flow? How do you move closer to the source? Which assets hold value when quality drains from the system? These questions separate observers from participants. Thank you for watching. If you learned something valuable, share which state you're tuning in from and what time you're watching. Your perspective adds to the map we're building together. Stay alert. Stay informed. Stay strategic. The laws of money never change, only the players do.